Hello and welcome. My guest today, Mr. Viral Acharya, is a professor of New York University, Stern School of Business. He is considered as one of the finest economists we have in these times. Let me welcome him.
So thank you very much, Mr. Acharya, for taking time out to talk to us. These are classic times, I think, where economists will not find parallel in the history, and it's uncertain time. A lot of people must be questioning you that what the future look like. But I think let me start with your own book, which you co-authored in 2008, Restoring Financial Stability: How to Repair a Failed System. How do you think we are going to repair this time?
So I think the challenge this time is that the shock that is underlying is not just a shock to the financial system through poor quality of underwriting of loans of its own. As we know, the global financial crisis largely was a crisis of very poor underwriting of real estate mortgage loans in many parts of the developed world, with very leveraged positions in the financial sector. And so when the unsustainable housing price boom and the mortgage boom ultimately came to a screeching halt, it led to sort of a complete unraveling of the leverage that had been built up in the financial system. Corporate parts of the world were doing reasonably well, actually, in the first 6 months of the global financial crisis, until the multiplication of the problems in the financial sector gradually started taking hold of first the household consumption, then gradually the real economic activity. And then, of course, finally, it came to a complete stop around the collapse of Lehman Brothers and several other large financial institutions. Now, that in some sense, that's a crisis that economists and certainly the banking folks in financial economics understand reasonably well. In contrast, what we have right now is that the shock is actually first and foremost essentially a temporary collapse of economic activity in a very large measure. Because if you don't stop the economic activity, either through individuals' own choices or through sort of an imposition of shutdowns or lockdowns by the governments, then you risk potentially very high contact intensity, very high spread of infection of the virus, and potentially fatality rates that may be not just costly from the standpoint of reaching the surge capacity in terms of available beds and emergency care, but it could also be a great loss of economic well-being of the countries to lose a very large part of your working population. And of course, the elderly also consume, and that's a very big part of the economic well-being. So besides leaving aside the sort of the humanitarian aspects of it, which of course there's an ethical question of what measures must one take in order to not transmit your infection to someone else and cause a potential loss of life or risk of a loss of life there. But leaving aside that humanitarian issue just for the time being, I do want to come back to it a little bit later on, is that even from an economic standpoint, this is first and foremost a simple stalling of economic activity. It's almost as though time has stopped, so to speak, because we are not doing the activities we were doing. Frankly, and somewhat thankfully, both the households and the financial sector right now, not in all parts of the world, but at least in the developed parts of the world, are in much better shape than they were at the time of the global financial crisis or a year prior to that. However, this time around, the impact is much more severe on the corporations themselves, large, small, micro enterprises. And to an extent, the governments also have much more bloated balance sheets because of the stimulus measures that they had taken on after the global financial crisis, which they did not completely unwind from. Of course, now, when you have a shock like this that affects the corporate, that affects the governments, at least in a long-term sense, because the governments will have to take on even more stimulus and debts on their balance sheets. It is bound to affect the financial sector. Of course, the stoppage of economic activity has led to loss of jobs all over the world. that has got to again have a direct impact on consumption, and through that, a spiraling down impact on even what we may think were reasonably insulated parts of the economy.
Right.
So I would say in many ways it's a more challenging situation, because it's not clear what the silver bullet is.
Right.
What a silver bullet for restoring financial stability, at least in our book, and I think many would agree, is that you
Right.
have to recapitalize the financial system, reduce its leverage, and you can have reasonable confidence that in a year or two it will come back to normal. In some sense, here you have what looks like a temporary shock.
Right.
But I think what is perhaps the less appreciated aspect of the shock is that it comes with a great deal of uncertainty. We are all living actually in a fog of uncertainty.
Exactly.
When will the first wave end?
Right.
Is social distancing, lockdown, shutdown enough to contain a second wave from arising down the line, even if we restart activities after the first wave?
Right.
When will a vaccine be found and delivered in large quantities so that we can kind of put a full stop on being concerned about the risks of second, third, and successive waves? And what uncertainty does in such times is that it creates a collapse of any investments and decision making, which has a slightly longer term horizon. People focus on sort of relatively short-term business decisions, short-term personal optimization decisions.
Right.
And it's not clear how you fix that. The only thing you can fix that with is to devote resources to identifying the vaccine and its production earlier. That's, of course, it can reduce the uncertainty if there is credible expenditures and progress being made.
Right.
The only other way that is out is to perhaps do more targeted lockdowns, have more stringent social distancing for those who are the most vulnerable, and have maybe a somewhat more relaxed norms for the younger, who at least with this particular virus strain are less prone to infection.
Right.
But it's a difficult situation. I think it is certainly unprecedented in our lifetimes. Many are comparing the scale and the pace of job losses that is happening already to the Great Depression. And in some ways, I think the closest global comparison we have is to the so-called Spanish influenza of 1918 to 20. Which in terms of fatalities was clearly more severe than what it looks like at present with the COVID pandemic. It seems from the data one observes that the decline in economic activity was not as large. I'm not sure entirely whether we understand fully why that is the case. Maybe the world was not as interconnected and trade reliant. It was right after World War I, when a lot of the supply chains had presumably been affected adversely anyways. But I think I would end with the thought that while the collapse of Lehman Brothers and its aftermath seemed certainly very daunting for the global economy, I still think that as policymakers and as academics, financial economists, banking sector experts, when we set out with the objective of restoring financial stability, it seemed a lot more tractable an endeavor and an exercise than what the present scenario puts upon us as a challenge. So I would say unprecedented challenge, and I would not understate the humanitarian aspects which are involved, which make getting the public policy right absolutely crucial in this case.
No, I completely agree. I think we are in the middle of it. So to make any kind of assessment on account of loss is very difficult because, as you said, that is very uncertain where it's going to stop. And then we start walking upwards. We don't know that path yet. But is it a safe assessment that comparing it with 2008, banks are far at a better place in terms of capital financing, in terms of their own internal checks and policies. So therefore, there is no risk of banks going down in this crisis. And especially in light of the fact that the banks may see more bankruptcies and bank defaults, which potentially can harm banks at some stage. But still, you would take it that the banks are not at a point where we need to really see them as a risk so far as the entire economy is concerned.
I wouldn't go as far. I think I would be comfortable in making the assessment that the banking sector and certain parts of the financial sector, sort of non-banking parts of the global economy, are somewhat better in terms of the extent of leverage and asset quality that they have. But I would say it's a bit patchy in terms of how it is in different parts of the world. I think banks in the United States certainly were reasonably well capitalized. Certain countries in Europe, Switzerland, maybe to an extent, the Scandinavian countries, financial sectors, I would say Ireland, UK, they made very big strides in recapitalizing their banking sectors. I'm less so sure about banking sectors in all emerging markets. They are not necessarily in as great shape, certainly not in China and some of the other large emerging markets, partly because they were not that vulnerable to the global financial crisis from a banking sector standpoint. They were more vulnerable through trade. And the collapse of global economic activity. And these countries in Asia especially responded with very large fiscal stimuli. And some of it has gone awry, and that is all coming to roost, the non-performing assets and the bad loans from there. Even I would say in the United States, where the banking sector is in much better shape, the proliferation of shadow banking or non-bank finance has actually meant vulnerability. And I think that partly explains why the Federal Reserve has already created programs to support investment grade bonds, junk rated bonds, because signs of fragility here would have meant that certain parts of the shadow banking would have probably gone belly up during the high volatility environment. Typically, this would have meant hedge funds, certain other kinds of non-bank financiers. So I think I would say the central banks in the developed economies have temporarily put a sort of a floor on asset price collapse in the Western economies, almost to a point where many are sort of complaining that actually the asset valuations are looking completely out of sync with what is happening to the real
stock
side
market
and the macro economy.
US where it is on,
Absolutely. It's always hard to tell once the central bank stimulus is so large, whether asset prices are reflecting fundamentals or are they partly reflecting the value of the floor that has been put as a commitment by the central bank to step in and provide large quantities of liquidity, and in this case also taking on of the risks in some of the markets. So I think what really remains to be seen is how the bankruptcies, especially the corporate bankruptcies, play out. My colleague Ed Altman at NYU Stern School of Business, he wrote this first credit risk model in the late 60s, and he has pretty much got every corporate recession right. Including this one. And his prediction is that we may see corporate default rates rise to the extent of 8 to 10% of the total outstanding corporate bonds in the United States. Now, that would be an extraordinarily large amount. It will lead to a fair amount of drawdowns of lines of credit that banks have provided to these corporations. It could mean clogging up of the bankruptcy system. And small businesses who have even fewer insurances in the form of credit lines available. In general, they are more fragile in terms of their operating leverage, etc. Many of them are likely to file for bankruptcies as well. So it remains to be seen once these losses, if and when these losses mount, what other situations are hitting bank balance sheets at that time? Let me just take a couple of quick examples. Will there be very large credit card drawdowns because people become unemployed and actually have to consume out of credit? Will there be mortgage defaults? Or today there's an article in Financial Times on how WeWork's inability to retain tenancy on its premises is going to cause a severe problem in the commercial mortgage-backed securities market for many years. So I think the initial condition for the financial sector in many parts of the world is somewhat better than at the time of global financial crisis. The shock is not to the housing markets. The shock is to real economic activity, and probably a larger shock will be corporate bankruptcies. But I think it's too early to say that that we are well capitalized. In fact, one thing I've been stressing in all my public talks is that it may be a good time for banking sectors all over the world, when the equity valuations have reached certain semblance of stability and the downward spiral has been arrested, to go to the markets and raise equity capital as soon as possible, shore up buffers in their balance sheets to absorb further losses. If things turn out well in a year or 18 months' time, this capital can be returned to the shareholders. But I think this would be a good time to do the defensive preparation, because if you leave it for 6 months or 9 months and things have actually gone to what looks like a relatively stressed scenario right now, I think it would be much more expensive than for them to issue equity. They may be reluctant to issue equity. And then we could be looking at a scenario that's not too different from the collapse of Lehman Brothers, because we are still in a heavily interconnected financial system.
I agree.
And a few large institutions not being able to withstand their losses could create a fair bit of panic and fragility and lack of confidence in the financial sector all over the world. We've seen that loss of confidence can happen very, very quickly with the modern financial system.
No, I agree. I think the negative sentiment is already building, and that's very visible, at least in the emerging economies all around. Arvind Subramanian recently said that it's not a rainy day, it's a deluge. It's a perle in terms of economic activities. And emerging economies, including India, I think it's going to be challenged that, what is the right size of stimulus for the corporates? That's the challenge. And in your economic understanding, is there any benchmark for emerging economies to place these kind of stimulus to a certain level when it's compared with the total GDP of the country?
I think it's hard to draw a sort of a broad brush conclusion, but I would make 3 points. First, that I think the focus primarily, in my opinion, should not be on corporates. The focus primarily should be first and foremost on the needed, necessary healthcare expenditures. Second, I would say it has to be on those individuals whose livelihoods are most affected by the pandemic and the stringent lockdown measures, etc., that have to be taken. So I would say the first and foremost, I think the humanitarian aspects of the pandemic crisis have to be dealt with. Second, I would say in terms of hierarchy of where the impact is the greatest, I think I already mentioned that small businesses are going to find it difficult to survive in this scenario. And so I would put them second in the hierarchy. Also, they are very large in number. They also are the biggest contributors in terms of jobs and employment, even if individually they might seem very small. Collectively, they are very, very important. And so I would say that is where I would put the second round of stimulus, maybe try and ensure that at least the healthy ones can survive. But we might have to accept that, perhaps some of the unhealthy ones, just like in any other regular recession, may in the end have to actually face some creative destruction and, soften the blow for those whose jobs are displaced as a result of that. And then
Right.
I would put the large corporates and other industries who have internal capacities actually to withstand such shocks of their own. There could be some mergers and acquisitions and
Right.
consolidation activity to give them better buffers. Those who have stronger balance sheets could acquire some of the weaker balance sheets. Because they are public and their balance sheets are transparent, due diligence, scrutiny required to do such consolidation activities more feasible. So I would, sometimes we end up listening to those whose names are more popular and they have a
Right.
bigger
Right.
voice in reaching to the media. But I think it's very clear to me that first and foremost, the medical and the humanitarian hunger related aspects
Be
have to be
taken care
dealt
of.
with. Next, I think small businesses, because that's where the job creation and employment is the highest. And then I would come to the large corporates. So
Right.
that's my sort of broad first point in terms of where I would direct the stimulus to the extent there is
Right.
capacity. And second point I would say is that there is too much focus on the size of the stimulus and not as much on the delivery.
Right.
And I think sometimes we have to realize that the kind of stimulus one is talking about here, where you have to reach at the grassroots level,
Target, yeah.
every in a very targeted manner to every township, every community, every neighborhood.
Right.
Sometimes even municipalities at the local level do not have actually the reach to get
Right.
to these points. So I think while attention is being paid on what size of stimulus there has to be, I think there has to be a lot of attention being delivered to the decentralized delivery of these programs. Who's going
Right.
to help you ensure a somewhat universal coverage in the most affected parts of the population? Is it the local level committees? Is it
Right.
community organizations? Is it NGOs? Is it some public sector entities who have reach in these in the nooks and corners of the society?
Right.
So I would say that as much attention has to be paid to those details as on the overall size of the federal or the state level stimulus.
Right.
And this requires respecting that ultimately it is decentralized entities who will be able to take the best decisions in a local area. And
Right.
finally, I would come to the issue of the size of the stimulus.
Right.
Most economists would agree at this point that if the stimulus is targeted in the sense
Right.
that it is about reaching the healthcare expenditures and the most affected parts of the displaced and those who are truly facing a humanitarian crisis, that one
Right.
has to find the budget to do that. Now,
Right.
for countries where there is fiscal capacity to spend in the sense that they are reasonably well rated and some additional fiscal slippage reaching to the bond markets for accessing funds, etc., is not going to create some sort of turbulent episode in your cost of borrowing.
Right.
I think I would say that they should just go to the markets and get the needful done. And many countries, including emerging markets who have such buffers, are doing it. Those who do not have such capacity, typically what that means is that they have overborrowed and overspent.
Right.
Certainly in the recent past, or they haven't consolidated enough from their excesses after the global financial crisis.
Right.
They have to just be ruthlessly rationalizing their expenditures. Identify what are the non-essential expenditures and temporarily put them off. We did not anticipate this situation. So clearly we can't just go along with every single expenditure as though life has not changed.
Exactly.
So you have to prioritize. And I think the hierarchy that I mentioned should make it fairly easy to figure out what needs to be cut out, what needs to be prioritized. And some rationalization along these lines would help. If they don't have capacity, but they want to go to the bond markets and yet not face some erosion of sustainability of their credit conditions, they would have to provide credible commitment for fiscal reforms. And each country may have to, depending on its situation, figure out how to provide that credibility. But I would say that going to the market in such a time for raising extra financing is not entirely out of the realm of possibility, even if you were a bit stretched, provided you convey a credible path. Words is not enough. You have to take some concrete actions in order to support rebuilding of credibility with the markets. But I think this is a time when it may be possible for emerging markets. Of course, for the extremely poor countries, aid is coming in a targeted manner in the form of debt relief and direct aid from several multilateral agencies, including the IMF, the World Bank, the Asian Development Bank, and so on. And, you know, those are essential for many of these countries. Don't forget that many of these smaller countries are oil exporting countries, commodity exporting countries, and they've had a huge collapse of commodity. Their trade, their terms of trade have got eroded very rapidly in a span of 2 months.
Right. No, I completely agree. I think, but since I'm not economist, I will not be able to comment whether what all kinds of countries are in position to go to the market. In my understanding, and whatever we're reading every day in newspapers, that the debate about the manner of raising funds. One way is that the bond you're borrowing is the best way that you can, in these times, then you can leverage beyond your targeted deficit also. And on the other hand side is that why don't you print your currency even if you are marginally degraded by rating agencies? So this debate of raising through bonds or printing currency, what difference it makes to any emerging economy particularly?
I think my sense is a large number of them are exploring a mixture of options. They are tapping bond markets for fresh financing. Many central banks are also explicitly or implicitly monetizing some of the fiscal relief expenditures of their governments. I think in general, in such times, because economic activity has collapsed, credit demand is low. There is also risk aversion in the financial sector and the savers. So there is an inevitable flight to quality, which typically in most economies would be towards their own government bonds and probably if they can take the money out, then in other safe haven currencies of the world. So by and large, government costs of borrowing in most parts of the world, including I would say in emerging markets, are not rising as quickly as one might have thought would be commensurate with the pace at which their debt to GDPs are rising. And that's because of this flight to safety and quality of the government bonds. Now, of course, the safe haven countries, sort of the large Western developed economies who have deep bond markets, very credible commitment to repay their investors, they are, of course, enjoying a reduction in their cost of borrowing. That's not true for most emerging markets. Most emerging markets have experienced some rise in their cost of borrowing. So in a way, therefore, their policy space is somewhat more constrained. And therefore, I'm of the view that what is not put front and square on the table by many who are rightly pushing for the fiscal relief measures are two things. One, that if your policy space is constrained, you have to identify where you had excess fat in your expenditures and you have to burn that fat. At least you have to become temporarily fit and reorient your expenditures towards the weaker parts of the body, so to speak, and get them to get the strength. And second, which is equally important, is that you need to provide credible commitment as to how you will bring your debt and deficit numbers back in line as and when the dust settles on the pandemic. What institutional arrangements are you putting in place? If they have lagged in their if they have lagged in their enforcement abilities, in their ability to discipline the governments, why should the investors, the rating agencies, markets believe that even though you are slipping and taking on higher numbers, I can be reasonably confident that as and when economic activity revives, you will follow a path of consolidation so that over a longer term, even though temporarily your fiscal looks unbalanced, over the longer term, the debt and fiscal path will look more sustainable. I think these 2 points need to be thought through a lot more seriously and entertained as alternatives.
Right.
One, to expand your policy space by shrinking somewhere else, and two, to keep your borrowing costs in line by building credible commitment with markets, investors, rating agencies. I think they need to be given a lot more attention, especially in emerging markets.
Right. Okay, coming to the larger issue of trade, I think last 2 decades have been fantastic when it comes to a world order and the cooperation around the world in terms of trade. But if we see last 2-3 years, there is a weakening of institutions like WTO and WHO. We are seeing currently the cracks emerging in that also. Do you see that the world is no more flat and we are going to see a different world order, which is going to be more inward looking rather than the outward looking? And second, if that happens, do you see the logistics cost, which is going to be borne by these inward looking countries, is going to make them economically unviable?
I think it's a great question, and it'd be somewhat hard to provide a satisfactory answer in a short amount of time, but I'll try my best. I think the deeper question one has to ask is, why is there a discontent over trade and globalization? And I think rightly or wrongly, the perception is that the gains from globalization and trade have not been well distributed in the society. They have primarily accrued to sort of large multinational corporations and those who invest in them. And then the redistribution of these gains to those who got displaced because you were arbitraging either cost of labor or other factor productivities across countries. Now, how do you deal with those who are displaced in their jobs? Do they have adequate safety nets? Are there enough reskilling opportunities for them? Is there equal opportunity in the society for them to now educate their children and get them onto a different professional path than what the parents had? And because I think to some extent, not all, but even some of the largest Western economies are failing in this redistribution, I think there is discontent. And, it's a human tendency to look for external culprits to blame when things don't go right. But as some of our philosophers in the country said, very often 99% of the problems lie inside you. And I think that applies to this in my view, that I think what has failed is actually the domestic policies of these countries. They have failed to redistribute. They have failed to invest in public goods. They have failed to invest in skilling, education, healthcare in many parts of this world. And therefore, as a result of many of these aspects, the general quality of life, real wages, etc., have not been rising that dramatically. Now, one point that is a bit ignored is that this heavy reliance on global trade and supply chains has been a massive contributor to the extraordinarily low inflation that has been experienced, which of course has benefited the poorest in these societies as well. But I think partly both the discontent at the level of individuals, which is getting reflected in the choice of the politics and the political leaders who are being brought to the helm, them taking on global trade and trying to tear it apart as a part of their populist agenda. And I think it's going to be a fairly interesting outcome to see how the pandemic kind of lands on top of all these underlying tensions and forces perhaps an even more inward-looking supply chain management at the level of corporations. Now, if that supply chain management is truly to build resilience, which is that it is to accept that we have to sometimes have buffers in our inventories, that we must have diversified supply chains so that we are robust and resilient to future climate change shocks and other kinds of stresses that may materialize, then of course it's not entirely inefficient. But if it is used if the pandemic gets used as a tool to produce purely domestic focus of the supply chains, even at the cost of efficient diversification across the world, I think that could mean a very significant loss of efficiency, consumer surplus, perhaps even higher inflation and costs of goods. I think it would remain to be seen whether it's likely to play out. My prediction is that unless the domestic policies are fixed right for redistribution to ensure that the public good provision improves in the Western economies where it is found wanting, that simply going after trade and supply chains to be made more domestic is going to backfire because ultimately it may not improve the quality of life and real wages or real income relative to real expenditures that big parts of the society are currently.
That also may not be the best way of governance to my mind. I think when it comes to governance, the public good is the primary objective. So if you are faulting on that, it doesn't help in that sense. No, I think I completely agree. I think we need to watch out that how this pandemic is going to pan out and how the world is going to reshape and adjust to this new way of living personally and economically. And I completely appreciate your point.
And I think there is, and I think it is really, I think it's a very interesting time in some sense for the large global leaders of the world, not leaders in an individual sense, but countries that are actually leading the large trade decisions and are setting sort of the tone for the extent of global cooperation on many big challenging issues. On the one hand, clearly situations such as the one we are witnessing makes it very clear that we cannot ignore risks such as climate change. In fact, there's a very interesting perspective on the pandemic, which I find very thought-provoking, even if sobering at the same time. Which is that as global warming has made the tropics much warmer, there is a migration of fauna, animals and birds from tropics towards the poles. And as a result of these migration, they are coming in contact with germs, bacteria, viruses that they have not yet built immunity for. And as a result, they are contracting them and then not having the immunity, the infections are spreading within their communities, and then zoonotic diseases are getting passed on to the mankind in some way. So at one level, everything that is happening calls for greater global cooperation, but the discontent at the level of the individual at the grassroots level that has been created is creating this unfortunate dynamic that it's going to become harder to get global cooperative solutions. And that's because I think the populist leaders are, misusing this discontent in order to, exactly, you put it in a very nice way, they're using the discontent to make muscular control, to take muscular control of private activity, rather than ensuring that they improve the delivery of public services and figure out how to finance those expenditures. And I think if the right questions are not asked of the leaders who have been elected, I think we could end up with some bad global policy, at least in the short run. Of course, my experience in history is that these cycles revert at a low frequency. And hope is that they revert before they've done lasting damage for several decades.
No, I think as the saying goes, let us not waste any crisis, and we should be better prepared to deal with the next one, which may come whenever it is likely to come. But I think I thank you very much that the insight is very useful. coming to maybe a last question on a personal note, how are you managing your personal interest, that is music, in this time of lockdown? Is it helping in any sense?
Oh, no, I think at some level, an academic's life doesn't change much from being locked down.
Right.
If anything,
which means that your school is still something which you
we are doing our teaching online, and our university, NYU, especially the business school, Stern School of Business, was very efficient in switching within 2 days to online on Zoom. The classes seem to be running reasonably well. Of course, it's a great deal of uncertainty even for the education sector. Certainly for the upcoming semester in the fall, will the new faculty and the new students, will they get visas? Will we even be able to have in-person classes, etc.? What is the future of education? Will it all switch to online? So it's sort of, there's a big fog of uncertainty in our business model. But at a personal level, I think it has not been that difficult at all. I keep doing my stuff. We keep playing a lot of cards and board games at home. But I have to say, in many ways, I consider ourselves very, very lucky to have a stable job and a work life that can be managed from home. But truly, my heart goes out to people who can't do that, who are not, for whatever reason, lucky enough to actually be able to manage well in such times. And therefore, I can't endorse more and more the call for fiscal relief, but I think it really has to be prioritized and targeted to those whose health and humanitarian needs are the greatest. And I think if I had to leave one message at the end of this talk, I think that is what I would stress. Ensure there are delivery mechanisms to reach the nooks and corners of the most affected parts of the society during the pandemic. I think that has to be the sole focus right now.
No, I think thank you very much. And I'm sure your voice will reach the right ears and we'll make an attempt on that. But it is always helpful. And thank you very much for your time. I think it's almost sleep time for you. But thank you very much. And I look forward to staying in touch with you, Mr. Acharya. Thank you.
My pleasure. And thank you very much for reaching out. And to everyone who watches this video, take care, be safe. And I wish you and your families the very best.
Right.